Welcome to our On Top of Tax webinar. I'm Bob Miller, tax partner in BDO's real estate tax team in London. There have been many changes to the UK taxation of real estate in recent years. Today, we will take you through those areas we see in practice that affect developers and investors in the UK and offshore. Our speakers are specialists from the BDO real estate tax team in London. Rob Williams will give an overview of the breadth of changes with a focus on real estate finance structures. Ed Peters will cover the new non-resident capital gains regime as it affects collective investment. Steve Watts will cover capital allowances and the new structures and buildings allowances. And Richard Dalton will deal with VAT and the new reverse charge on construction services. During the presentations, please feel free to submit any questions using the right-hand side of your screen. We will circulate replies to your questions following the webinar, along with copies of the slides.
Hi, I'm Rob Williams, a tax director in BDO's London Real Estate and Construction Sector team. To set the scene, it's worth putting into context the volume of change we have seen to real estate tax rules in recent years. The changes have been significant and in many instances wholesale, rather than merely targeting contrived tax avoidance schemes. This slide shows the main measures I will be touching on today, but even these are a drop in the ocean compared with the complete list of tax changes impacting the real estate sector. In many instances, the interaction of the changes is itself problematic. Often dealing with the impacts of one change puts a business firmly in the crosshairs of another. What we have here is a typical UK investment property structure. Investors, some of which will be offshore, investing into UK property through an offshore holding company and subsidiary located in perhaps Luxembourg, the British Virgin Islands, Channel Islands or the Isle of Man. The PropCo will have a subordinated shareholder loan as well as bank debt. This has been the default real estate structure for several decades, giving deductions for interest on both the bank and shareholder loans as well as a tax-free exit, whilst the non-residence of the PropCo would generally mean no UK withholding tax on interest. The main risk with this type of structure was transfer pricing, and specifically whether the terms of the shareholder debt are market rate. Today, when we are asked to consider how new UK property investment transactions should be structured, we have to consider the fact that from April 2020, non-resident landlords will be brought within UK corporation tax, the key impact being the new corporate interest restriction and anti-hybrids rules that were introduced for corporation taxpayers in 2017. The anti-hybrids rules are designed to deny a UK tax deduction for payments made under a hybrid financial instrument, for example a debt for the payer but equity for the lender, and or to a hybrid entity, such as a partnership that is treated as tax transparent in one jurisdiction but opaque in another. So in this structure, the shareholder loan might be vanilla. However, if this loan was itself funded by a profit participating loan, from April 2020, this may well be regarded as an imported mismatch, with the result that interest deductions in the PropCo are disallowed. In some cases, this will need substantive restructuring, such as re-domiciling to another territory. In others, though, a more straightforward change to the terms of the shareholder debt may be sufficient. In addition to the anti-hybrid rules, late paid interest rules may be an issue. These rules are only applicable to corporation taxpayers and defer a UK tax deduction for certain interest, where it is not paid within 12 months. Whilst they've been around for a long time, they generally only now apply to closed companies in tax havens, but they do still require consideration. We still regularly see investment structures using payment in kind notes, and these rules make it important to remember to issue the PIC note to secure the UK tax deduction. The corporate interest restriction rules, which implement the OECD's BEPS Action 4, restrict tax deductions for financing costs to the lower of 30% of tax EBITDA, a group ratio percentage, and a £2 million de minimis. This means that net financing expense above £2 million may be restricted. Under a group ratio election, groups should generally achieve a full deduction for third-party financing costs, but deductions for related party financing costs can be further restricted. Detailed analysis is required to confirm the deductions. This should be done early on based on forecasts and not left until late in the compliance cycle. This is because one of the key elections, the Public Benefit Infrastructure election, must be made before the accounting period ends. So what are groups doing following the corporate interest restriction? Well, some simply have to concede that there is no longer a benefit of having shareholder loans and using preference share funding instead. Others are looking to partner with third parties and establish joint venture companies. For example, a 50-50 JV should generally be a separate group and have its own £2 million worth of tax deductions for financing costs. Others may achieve a similar result if they do not consolidate their property SPVs. Or we have advised on other situations where an orphan structure achieves an equivalent result, i.e. has its own £2 million of tax deductions. If none of these routes are commercially viable, various corporate interest restriction elections can be considered. In addition to the public benefit infrastructure election and group ratio election referred to already, there are broadly another dozen elections which may help to manage and maximise tax deductions. Moving away from corporation tax, it's worth highlighting a couple of other recent developments impacting real estate investors. Firstly, new economic substance rules have been introduced by the Channel Islands, the Isle of Man, and other commonly used offshore jurisdictions from 2019. These will not apply to real estate investment SPVs, but may apply to holding and financing companies. A risk with the new economic substance rules is that it may lead to tax authorities challenging the tax residency of propcos. If successful, this could mean that the propco is liable to UK tax on its worldwide income and gains, and potentially also withholding tax on interest. And that leads on to withholding tax. While HMRC's guidance has for many years been that the residence of the paying entity is critical in deciding whether interest has a UK source or not, recent cases leave some doubt. If the reaction to the corporate interest restriction, economic substance requirements and new tax on non-resident capital gains, which we'll talk about separately, is to bring property companies onshore, they may now, for the first time, be subject to UK withholding tax on interest. Real estate investors therefore need to consider the basic tests. Is the interest short or annual? Is recipient in the EU? But Brexit could change things in this regard. Is treaty relief available? And on the question of treaties, the OECD's BEPS Action 6 has restricted many treaty benefits where there is a tax avoidance purpose. And this has led to changes to a number of treaties over the last couple of years, with more likely to follow, including the UK-Luxembourg Treaty, which is currently being renegotiated. The number of withholding tax failures we see in due diligence exercises never ceases to amaze. Turning to developers, take a non-UK company that's developing a UK site. In the past, the non-UK company may have claimed treaty exemption from UK tax. We know that the revenue never liked or accepted this, but for many years struggled to do anything against it. But from 2016, all profits from trading and developing UK land are within the charge to UK corporation tax. And this has meant that from 2017, developers are also within the scope of the anti-hybrids rules and corporate interest restriction, amongst other measures. Previously, it could be assumed that the accounting profit for developers would be the same or very similar to the taxable profit. Now, though, developers are facing restrictions for financing costs. They also need to consider whether to capitalise or expense financing costs in the accounts. Capitalising throughout the development and releasing them to profit and loss when the completed units are sold runs the risk that the interest will be more than the £2 million de minimis in the period of sale. The company may then never achieve full tax relief for the financing costs incurred. Expensing the financing costs each year could help, but not if all it does is create tax losses carried forward. This is because the new loss rules can restrict brought forward losses to 50% of profits, subject to a £5 million de minimis. Again, the company could end up never obtaining full tax relief for the costs incurred, and instead be stuck with tax losses that are ultimately extinguished on cessation of trade. Developers should therefore model these issues at the outset of a project to prevent tax leakage. And all of these issues can impact on deferred tax recognition as well. Finally, there are the recently amended transactions in land provisions, which can recategorise what would otherwise be a capital disposal to be taxed as a trading transaction. In this structure, if the non-UK holdco always had the intention of selling the shares in the devco, there's a risk that the holdco will be taxed on the sale of the devco's shares. In that case, expensing financing costs during the development period in the devco could at least give rise to tax losses that may be group relieved to the holdco to offset the transactions in land profit. Given all the pitfalls associated with traditional investment and development structures, we're starting to see interest in establishing or restructuring into new or existing but historically rarely used structures as a solution to these issues. There have been a proliferation of new UK REITs over the last couple of years, but we're increasingly talking to clients about PAIFs, contractual schemes, and certain other vehicles that were previously seldom seen. Whilst some of these regimes have significant tax benefits, they don't work for all investors. REITs and PAIFs, for example, will not work for companies looking to do a mixture of property investment and development. A possible alternative in that situation is the investment trust structure. To date, this has scarcely been seen as a vehicle for investment in UK property, but it has some flexibility and can achieve an equivalent or even better tax result. Why is this? Well, the investment trust is exempt from UK tax on gains. This means that property held by it directly can be disposed of tax-free, with sales of property-owning subsidiaries also entitled to exemption. Unlike the UK REIT and PAIF regimes, however, it is not limited to property rental activity. Accordingly, an investment trust might be suitable for pub and hotel groups, as well as property developers. The investment trust and its subsidiaries will not benefit from tax exemption on income profits, but unlike the traditional structures featured earlier, where it may no longer be possible to mitigate UK taxes on income using shareholder loan funding, the converse is true for investment trusts, as an investment trust can obtain a tax deduction for the payment of interest distributions, with any interest distributions specifically excluded from the corporate interest restriction regime. So what we have is a regime that is capable of minimal or no corporation tax on income, no tax on gains, applicability to both traders and investors, and it can be entirely UK-based, thereby alleviating the need for offshore management as often was required in the past. Furthermore, for mixed trading and investment groups, it's possible to convert from an investment trust to a UK REIT or a PAIF at a later date if the balance of the group's business moves towards investment. The investment trust regime has its conditions, such as a requirement for the trust to be non-closed and its shares to be admitted to trading on a regulated market. However, its conditions in general are less onerous than certain other structures. So I've tried to address some of the pitfalls coming out of the many recent UK tax changes and how these are impacting real estate structures, as well as offering some light at the end of the tunnel. If you have any questions on the back of this, please do get in touch with me afterwards.
My name is Ed Peters, and I'm a director in the real estate tax team at BDO. The purpose of my presentation is to discuss the wide-ranging changes that have been introduced to the taxation of capital gains or disposals of real estate by both non-UK and UK tax residents. These changes were effective in April 2019. It's therefore important for all property owners to have knowledge on how the new rules may impact them. To the extent there are any questions, please do contact me after the webinar and I'll be happy to assist. To give some background on the changes, prior to April 2019, the position on capital gains arising on the disposal of non-UK real estate was that, subject to a few specific exceptions, such as real estate investment trusts or REITs, all UK tax residents were subject to tax on capital gains arising to them, and non-UK tax residents were exempt from UK tax on capital gains, other than those arising in connection with residential real estate. From April 2019, the general position is now that UK tax applies to all real estate disposals, companies being subject to corporation tax on such gains, and other taxpayers to capital gains tax. The new charge applies to both direct and indirect property disposals. Therefore, in the simple scenario covered in this diagram, both a direct disposal of the property by the non-UK PropCo and a sale of the shares in either the non-UK PropCo or the non-UK HoldCo would now generally be subject to UK tax. That being said, the rules were introduced with the intention of taxing only economic gains arising after the new legislation was introduced. Therefore, all non-UK resident owners of commercial real estate are entitled to benefit from a rebasing of their property interest for capital gains purposes from 5th of April 2019. This rebasing applies to both property and share disposals. To the extent it produces a better outcome, taxpayers can also elect to use historic cost for their capital gains calculations, although there are some restrictions in the use of historic cost for share disposals. It's also important to note that residential properties rebased to 5th of April 2015 rather than 5th of April 2019, although shares in companies which own residential real estate are still rebased to 5th of April 2019. There's no formal requirement to actually obtain a valuation. However, as for other similar tax valuations, such as Market Value 82, it would generally be preferable to have some formal support for valuations used in the event of inquiry. It's important to be aware that one exemption from the new charge applies on share disposals. If a shareholder owns less than 25% of a company, including shares owned by their associates such as relatives, there is an exemption from the charge. However, this does not apply where a company invested in is a collective investment vehicle. I will cover collective investment vehicles in more detail now. After the changes outlined in the previous slide were announced, HMRC underwent an extensive public consultation process. As a result of that consultation process, further legislation was introduced concerning collective investment vehicles or CIVs. The purpose of the CIV legislation was to relax the new capital gains rule charge in certain circumstances and to clarify particular technical issues created by the new rules. A collective investment vehicle is, broadly, any collective investment scheme within the usual FISMA definition, an alternative investment fund or AIF, a UK REIT, or a non-UK resident company which is exempt from tax in its jurisdiction of residence, distributes 90% or more of its income, earns more than 50% of its income from long-term property investments, and is diversely owned or non-closed. This final category of CIV is intended to capture non-UK REITs, but also extends to a wider range of property investment structures, such as Channel Islands companies. It will be clear from the description of entities that can qualify as a CIV that the definition is wide, and many property investment structures will fall within these rules. Likewise, certain structures, such as companies resident in the UK, may not fall within the rules, even if they have a diverse pool of investors. We now come on to an explanation of why these rules matter. The CIV rules, as noted above, provide a number of modifications to the general capital gains rules concerning the taxation of UK real estate. The first modification concerns so-called hybrid entities. These are entities such as property unit trusts, which are treated as transparent for the purposes of tax on income, but have historically been treated as companies for capital gains purposes. Historically, the fact that property unit trusts were treated as companies for capital gains purposes was largely irrelevant, as the UK would not ordinarily tax capital gains on the disposal of assets by non-residents. However, with the introduction of the new capital gains rules, concerns were raised that the extension of UK capital gains taxation to non-residents meant that additional layers of tax were going to be created within property unit trust structures. As a result, HMRC have introduced a regime which enables hybrid entities, such as property unit trusts, to be elected to be treated as partnerships for UK tax purposes. The practical impact of this election is that additional layers of tax are eliminated for elected hybrid entities, meaning that their investors pay tax on income and gains arising to them as if they're arising to them directly. The second modification concerns the 25% de minimis referenced above for disposals of shares, as set out in the scenario on the right-hand side of this page. Where a disposal is made of shares in a CIV, or in a case where a disposal has an appropriate connection to a CIV, the gain is automatically taxable, irrespective of the amount of shares that are held. Practically, this brings all investors into CIVs into the scope of UK capital gains taxation, however little the investment they hold is. The final and most important modification that the new rules have introduced is a CIV exemption election. I will discuss this in detail as it's complicated and has some very important implications. To qualify for the CIV exemption election regime, the structure in question must fall into two broad categories. Firstly, if a company is owned 99% or more by partnership, it is capable of qualifying. This is seen in the first diagram on this page. The company in question can be either UK or non-UK tax resident. Secondly, a non-UK REIT or REIT equivalent structure can also qualify. This is seen in the second diagram on this page. For the purposes of these rules, a property unit trust would also be capable of qualifying. Under this element of the test, the CIV itself must be non-UK tax resident, although the underlying property companies themselves can be UK tax resident. In both cases, there's a further requirement that the structure in question is diversely owned, as well as other general conditions such as the fund being UK property rich. For those of you familiar with the terminology, this requires the structure to be non-close. A close company is broadly a company the equity in which is owned 50% or more by 5 or fewer shareholders. This means at least 11 independent investors are required to qualify for the regime. However, it's important to note that certain institutional investors are not counted for the purposes of this test. Therefore, even if a structure has only a single institutional investor, it is capable of electing into the CIV exemption regime. The definition of an institutional investor is complicated, but categories of investor that can potentially qualify include pension funds, insurance business, sovereign wealth funds, and governments and charities. It's important to note that one possible downside of electing into the exemption regime is that there are certain reporting requirements. These include the reporting of investors by the elected fund and reporting of capital disposals within a fund. The benefits of electing into the exemption regime are that direct property disposals and disposal of shares within an elected fund are exempt from UK capital gains taxation. In the diagram shown, this would mean that, for example, any disposal by or in a propco or a disposal of a holdco would be exempt from UK tax. Furthermore, in most cases, where a propco is sold, real estate held by that propco is rebased. The practical impact of this is that any capital profit within that propco disappears for tax purposes. This potentially makes COV propcos attractive to purchasers. It's important to note that this exemption regime applies irrespective of the residence of the companies within the fund. Therefore, there will now be structures where UK resident companies, which were previously taxable on capital gains, will be able to benefit from an exemption from UK tax on capital gains. In general terms, the impact of the CEV exemption election is to give elected structures equivalence with UK REITs in terms of the tax treatment of capital gains arising to them, as UK REITs are also exempt from tax on capital gains. The downside of electing into the exemption election regime is that capital gains which have been exempted within a fund are taxable to the extent they are distributed out of a fund or on, for example, the winding up of a fund. There are also anti-avoidance rules to stop the extraction of gains out of a fund in a non-taxable form. Therefore, the regime will usually only be beneficial where the intention is to roll up capital gains within a fund regime and only distribute income on an annual basis. This means it's important to assess on a case-by-case basis whether electing into the regime will be beneficial or not. However, an important exception to this is structures in which the ultimate investor is an institutional investor. In those circumstances, distributions from the structure are often also exempt, providing a full exemption from UK taxation on capital gains. In addition to the CIV exemption election, a further exemption was introduced for trading structures with significant property interests. This exemption was introduced with the aim of providing capital gains exemptions for so-called OpCo-PropCo structures, such as that depicted in this diagram, whereby property ownership and trading activities are segregated into separate structures. This structure is common with particular asset classes such as hotels and student accommodation. Without an exemption, in this scenario, a disposal of the PropCo would be taxable in the UK. However, if certain conditions are met, the trading exemption exempts the disposal of the PropCo in such structures from capital gains taxation. The capital gains status of the PropCo itself is unchanged. However, the exemption only actually applies if the PropCo and the trading operations are sold together. This means that in many cases the exemption may not be available in practice. It may therefore be better to rely on the substantial shareholding exemption instead, as this provides a more flexible exemption. To recap on the content of this presentation, UK capital gains taxation has been extended to all owners of UK real estate wherever resident. However, a number of potential exemptions have been introduced, including the IV Exemption election regime and the trading exemption. These exemptions can be full or partial depending on the exact structure of an investment and the nature of investors. Therefore, going forwards, it's important to always consider which exemptions, if any, are or may be available to exempt capital gains arising from UK real estate disposals. These exemptions can be available even for UK tax resident structures.
My name is Steve Watts. I'm a Capital Allowances Director in the real estate team in London. In my session today, I'm going to focus on the recent changes to the UK capital allowances regime, and in particular the new structures and buildings allowances, including some of the key practical considerations of these changes. Over the last few years, there has been a great deal of lobbying for the introduction of a tax allowance for expenditure on buildings or structures. This was identified as an area where the UK tax system has historically been uncompetitive against other major economies. It is also an allowance that can assist in encouraging investment in buildings or structures. The results of the Office of Tax Simplification Review, which considered replacing UK capital allowances with accounting depreciation, was published in June last year. This recommended the introduction of a buildings allowance as a long-term policy. So it was as a big surprise to many that the autumn budget announced the immediate introduction of structures and buildings allowances from 29th of October 2018. Although structures and buildings allowances were announced and will be introduced from that date, only provisions for its introduction were included in the Finance Act 2019. Draft legislation has been subject to a period of consultation, and on the 19th of June this year, legislation was due to be laid before Parliament to provide for this new capital allowances, which is expected to come into force. We expect final legislation alongside specific technical guidance to be published during the summer. Therefore, we are in a period for which the structures and buildings allowances potentially applies, but the legislation on how it operates has still not been enacted and published. Firstly, I will provide a brief overview of the main conditions for structures and buildings allowances. SBA is available for expenditure on the construction, alteration, refurbishment, or the acquisition of buildings or structures. However, there's a caveat to this in that it will only apply where the original contract for the construction of the building or structure was entered into on or after the 29th of October 2018, and expenditure was incurred after that date. There are also some specific conditions. Dwellings are excluded, which will be specifically defined for these purposes, but will include dwelling houses, residential accommodation for pupils, student accommodation and prisons, etc. It is a real shame that the government have not considered extending this relief for some of the areas of residential sectors to encourage investment in particular areas, given the requirement to increase the stock of housing in the UK. The expenditure on land, acquiring interest in land and planning permission are also specifically excluded. And in contrast to plant and machinery, expenditure for which allowances are available in the year the expenditure is incurred, structure and buildings allowances are only available when a building or structure is first brought into qualifying use. This will mean for larger construction projects, the actual allowances may only be available many years after a construction project commences and the building is first let or occupied. SBAs will be available at a rate of 2% per annum on a straight line basis, giving relief over a 50-year period. Any expenditure on plant machinery and integral features is also not eligible for the structures and buildings allowance, and therefore it will still be necessary to segregate expenditure on these assets to the relevant pools for which faster tax depreciation will be available. A consequence of this is that structures and buildings allowances will not be eligible for the annual investment allowance, which currently is available up to £1 million per annum up to the end of December next year. One of the major differences is the interaction with capital gains tax. On disposal of an asset, any structures and buildings allowances that are claimed will need to be taken into account in the capital gains tax calculation. This will reduce the base cost of the asset. This means that the allowance will really be a timing difference rather than a permanent difference. In respect of the rules, there are some specific practical points that need to be considered to be able to claim structures and buildings allowances. One area where we've already had lots of inquiries is whether a project could be eligible for the relief. As stated earlier, allowances are available where construction contracts are entered into on or after the 29th of October 2018. However, it is also necessary to consider if any preparatory works, such as demolition or enabling works, were commenced prior to that date, with a view to bringing into existence a building or structure. If this is the case, then the allowance may not be available. A relevant interest in the land is also required to be eligible to claim the allowance, and different interests in a building may be able to claim allowances at the same time based on the expenditure incurred. So, for example, a landlord would be entitled to claim allowances in respect of expenditure incurred on the construction of a building, and a tenant is separately entitled to claim allowance in respect of elements of its fitting out expenditure on the building during its period of the lease. For a leasehold interest, at the end of the lease, the allowances ends and any remaining structures and buildings allowances would be lost. For subsequent expenditure on a building or structure after its original construction, for example, an extension, refurbishment or conversion, will be eligible for its own separate allowance over a separate 50-year life. Buildings that are used for residential purposes will be excluded, but also this will be extended to any areas ancillary to the residential use, for example, communal areas. This is a major difference to the plant and machinery rules because although dwellings are specifically excluded, any plant and machinery within the communal areas can qualify for plant and machinery allowances, whereas for structures and buildings allowances purposes, this will be non-allowable. On the sale of a building, there is no balancing adjustment. The purchaser simply will take over the residue of the remaining allowances over the rest of the 50-year life period. One area to consider is that the grant of a leasehold interest for 35 years or more for a premium, and providing the premium is 75% or more of the value of the retained interest, that will be considered a disposal for SBA purposes, and the lessee will be entitled to claim the allowance rather than the lessor. However, one major area to think about is that for any allowances to be available, an allowance statement will be required, and I'll come on to look at this in a bit more detail later on. Entitlement to claim the allowance will arise where a building or structure is constructed or acquired. It is necessary to consider the specific circumstances to determine the amount of qualifying expenditure that is available for the structure and buildings allowance. So, where an owner or an investor is constructing a new building, the qualifying expenditure is based on the capital expenditure incurred on that qualifying building or structure. However, where an existing building is acquired and the original construction expenditure on that building was under a contract entered into after 29th of October 2018, the allowances can be available to the purchaser. However, it is necessary to consider who the building is being acquired from and whether at the time of acquisition the building is being acquired used or unused. So, as detailed in the diagram above, for example, where an existing building is acquired from an investor and the building is unused, the qualifying expenditure is based on the lower of the sum paid for the building and the capital expenditure incurred on the construction itself. However, if the building is acquired used, there is no balancing adjustment for the seller, and the purchaser simply claims a residue of the allowances over the remaining life, as I mentioned earlier. However, where the building is acquired from a developer, it is necessary to consider whether it's used and unused because the basis of the qualifying expenditure is different as outlined in the diagram. One of the key considerations to be able to claim structures and buildings allowances will be the need to satisfy the allowance statement requirement. The draft legislation states that the qualifying expenditure will be nil unless the allowance statement requirement is met. This applies where a building is constructed or the relevant interest is acquired, and this is going to be a key point for claiming the allowances going forward. An allowance statement needs to provide certain information, but the legislation does not clarify if this has to take a specific form or if it is required to be submitted as part of the tax computation or return. The allowance statement needs to detail certain information, including identification of the building or structure, the date of the earliest written contract for the construction of that building or structure, and the amount of qualifying expenditure incurred on the construction or the acquisition of that building or structure. In addition, the date the building was first brought into non-residential use. So an allowance statement will be required to be prepared for the construction or refurbishment or alteration of any new construction projects. And where an existing building or structure is acquired, it will be necessary to obtain an allowance statement, or at least a copy of it, from any previous person who was entitled to the relevant interest in the building or structure that was eligible for SBAs. As stated earlier, without an allowance statement, no structures or buildings allowances will be available. This table summarises the main capital allowances and reliefs available and highlights the changes that were announced in the last budget. The increase of annual investment allowances to £1 million per annum for a period of 2 years and the introduction of structures and buildings allowances got the headline news in the budget. However, other changes in allowances offset the benefit of these changes. This includes the reduction in rate of the special rate pool from 8% per annum to 6% per annum from this April, and also the withdrawal of enhanced capital allowances for energy saving and environmentally beneficial plant machinery from next April. In addition, the longer-term interaction between capital gains tax and structures and buildings allowances should also not be overlooked. In summary, the introduction of tax allowances for buildings and structures is clearly welcomed. As explained, some of the rules are complex and are inconsistent with the treatment of other existing capital allowances. However, without careful consideration of the legislation once it is finally published, and ensuring that the required documentation is in place, could result in the loss of the allowances available.
Good afternoon. My name is Richard Dalton. I'm a partner specialising in VAT in the real estate and construction sector. I'd like to take this opportunity to thank you for joining us for this video webinar. In this section, we will focus on the forthcoming introduction of the VAT domestic reverse charge for building and construction services, often referred to by the acronym DRC. As many of you will be aware, the change was first proposed in 2017, and following consultation with various industry bodies and the publication of draft legislation and guidance, the DRC is scheduled to be introduced with effect from the 1st of October 2019. It will represent a significant change to the way in which VAT is accounted for on supplies of certain types of construction services to VAT-registered businesses. And while the change will necessitate an element of administrative change on the part of all concerned, my view is that the "so what" factor with this particular change to the way VAT is accounted for is its material impact upon cash flow and working capital within the construction sector. In order to better understand the impact of this change, it may first be useful to recap on the way in which VAT currently works in the construction sector. In common with most other industries, a UK-based supplier of construction services supplying standard rated services, those that are subject to VAT at 20%, to a UK-based customer will currently charge and account for VAT at 20% on its supplies. The recipient of those services, if it receives them in the course or furtherance of an economic activity that gives rise to the right to recover VAT, will then recover the VAT subject to the normal rules. This is a simple process which is common in all supply chains. So, what is the issue with the construction sector? The reality is that in the construction sector, the values at each stage, and therefore the corresponding VAT element, are of significantly greater magnitudes. This is a factor that HMRC believe makes the sector attractive to, and vulnerable to attack from, organised crime. HMRC understand that entities with low levels of VAT to reclaim, input tax, and high levels of VAT to pay, output tax, may charge VAT on sales and then fail to account for the VAT to HMRC, and instead abscond with the VAT. To put this into the context of our example, subcontractor 1 would charge VAT to subcontractor 2, but instead of accounting for the VAT to HMRC, would then retain it before disappearing as what HMRC refer to as a missing trader. HMRC intend to introduce the DRC to remove this risk. After the 1st of October 2019, suppliers of certain types of construction services will not be required to charge and account for VAT on those services. In the supply chain we looked at earlier, this will mean that subcontractor 1 will raise an invoice for, say, £100 to subcontractor 2. However, subcontractor 1 will not charge and declare £20 VAT as output tax to HMRC on its VAT return for the relevant period. Rather, subcontractor 2 will include £20 as input tax and a corresponding entry of £20 output tax on the same VAT return. Assuming subcontractor 2 is entitled to full VAT recovery on its costs, it will be in a nil net position in respect of its purchases. Subcontractor 2 will then charge £500 for its services to main contractor and raise an invoice to main contractor for £500. As with the previous step, subcontractor 2 will, in turn, not charge and account for the £100 VAT as output tax to HMRC on its VAT return for the relevant period. Main contractor will instead include £100 as input tax and a corresponding entry of £100 as output tax on its VAT return. Again, assuming that main contractor is entitled to full VAT recovery on its costs, main contractor should be in a nil net position in regard to its inputs. Since the developer is the end user, it should provide the main contractor with a written confirmation of its end user status. This will enable the main contractor to then charge £1,000 plus VAT for its services to the developer or end user and raise an invoice to the developer for £1,000 plus VAT. Main contractor will declare the £200 VAT as output tax to HMRC on its VAT return for the relevant period, and assuming developer is entitled to full VAT recovery on its costs, developer will in turn recover the £200 VAT as input tax on its VAT return for the relevant period. This change achieves the desired effect of removing the risk of parties being able to charge VAT and fail to account for it to HMRC. However, it also has the potentially unintended impact of removing much needed positive cash flow and therefore working capital from the supply chain. While it is possible that Subcontractor 1 is a fraudster seeking to charge VAT and fail to account for it to HMRC, in my view, it's significantly more likely that Subcontractor 1 is a small or medium enterprise operating on very narrow margins. If this is the case, then the VAT that Subcontractor 1 currently charges may well provide it with significant working capital, i.e. up to 20% of its turnover, between the time it receives the payment from its customer and the time that it is legally required to account for it as output tax to HMRC. Just to expand on that, if Subcontractor 1 raises an invoice on the first day of its VAT period with payment terms of, say, 30 days, and receives the payment in line with those payment terms, then it should have access to the VAT as working capital until the VAT return and any payment is due to HMRC. Typically, this is the 7th day of the second month after the period ends. This may well be vital working capital for Subcontractor 1. The issue is then replicated for Subcontractor 2, with any potential cash flow benefit of a reduction in delay on the recovery of input tax outweighed by the cash flow disadvantage of foregone output tax. Provided the end user has issued an end user confirmation to the main contractor, the main contractor should charge an account for VAT as usual. The key points to understand, therefore, are which services the DRC will relate to and how an end user is defined. The services covered by this change are broadly those services that fall under the construction industry scheme. HMRC's updated guidance issued on the 7th of June 2019 has clarified that this will include supply and fix works. For example, we now know that a joiner constructing a staircase off-site, then installing it on-site, is making a supplier of a reverse charge service, even if the charge for installation is only a minor element of the overall charge. Further, HMRC have stated that if there is doubt as to whether a type of work falls within the reverse charge scheme, as long as the recipient is VAT registered and the payments are subject to CIS, the reverse charge should apply. However, HMRC have also confirmed that reverse charge will not apply to employment businesses who supply construction staff. HMRC see this as a supply of staff by their employer and not supplies of construction services by the workers themselves. The important distinction between supplying staff and supplying construction services from HMRC's perspective is that the individual workers are employed or paid by the employment business and not by the construction business that uses them to provide construction services. This seems a fine distinction to me, and one where I think that there is scope for mistakes and potentially abuse. It is clearly crucial to understand whether supplies of qualifying services are being made to an end user. HMRC's updated guidance states that where the customer status is not clear, the supplier should ask the customer if they are an end user or intermediary supplier, someone connected with the end user, and keep a record of the answer. It is the responsibility of the customer to make the supplier aware that they are the end user or intermediary supplier, meaning that the reverse charge does not apply. However, in my view, HMRC have inadvertently created the possibility for errors by stating in their updated guidance that sometimes it may be obvious that the customer is an end user. For example, if there is a repeat contract or where sales contracts are clearly set for consumer sales, so it will be acceptable to charge VAT in the normal way. I do not think that this is helpful and again creates the potential for errors or abuse. Allowing a supplier to make a decision in the absence of an end user confirmation creates a risk that services could be treated as subject to VAT when they should have been treated as subject to the reverse charge. HMRC's guidance reiterates the fact that there will be a light touch in the first 6-month period following the implementation, provided the business is trying to comply with the legislation and has acted in good faith. However, HMRC says it may assess for errors during the light touch period, restricting penalties to cases where they believe the business is taking advantage of the measure by not applying it correctly. Where an end user has not provided written confirmation, resulting in the reverse charge being applied incorrectly, HMRC will expect the customer to notify the supplier that it is an end user and request a corrected invoice. However, in the absence of an end user confirmation, the main contractor is required to treat its suppliers as subject to reverse charge, and you will see that there is a clear temptation for the end user not to issue an end user confirmation and generate a cash flow advantage for itself. We would strongly recommend that end users do not seek to manipulate the new rules to obtain a cash flow advantage, particularly given HMRC's comments in respect of a light touch approach. In a sector where margins are tight and payment terms are fiercely negotiated, we anticipate that the reduction in working capital at all levels below main contractor will have a significant impact throughout the supply chain. As you can see, there are a number of practical aspects to bear in mind, and we should be pleased to arrange a call to discuss these separately if they are relevant to you. To conclude, in the short term, the DRC will increase the administrative burden faced by businesses in the construction sector, and it will have an ongoing impact on working capital in the sector. HMRC are aware of the risk to the supply chain posed by the impact that the DRC will have on cash flow and working capital, and their response has been to point out that there is a significant lead-in time to implementation, and therefore those affected have time to find a solution. It is not clear to me what easy solution any business would have to finding an alternative source of funding equal to up to 20% of its turnover. Therefore, while the main contractor will doubtless have commercial reasons for maximising its own working capital, it should nevertheless be aware of the increased stress that its subcontractors will be facing. There may be need for main contractors to work closely with subcontractors to agree payment terms that ensure that the risk of any negative impact from the DRC can be as closely managed as possible. I strongly recommend that any business impacted by these changes follow the position closely and seek advice on what steps they need to take to remain compliant and manage the commercial impact.
Thank you for joining our webinar. We hope you have found it useful. If you would like any further information on any of the topics, or if you have any feedback, please email me at bob.miller@bdo.co.uk. Alternatively, you can email any of the speakers directly on the addresses given in the slides, or our central real estate tax email address, ukproptax@bdo.co.uk. Thank you to those who have submitted questions during the webinar. We will send out replies along with copies of the slides. We look forward to seeing you at a future event.